Well, good evening, everyone, and welcome to tonight's COVID-19 Town Hall. My name is Scott Inman, and this is John Shrewsbury and Janet Walker, co-founders of GenWealth Financial Advisors. We are glad to have you along for the next hour or so. We're going to talk about some things pertinent to the coronavirus pandemic going on across our country and how that has affected markets, potentially your retirement, potentially your investments. So we want to start by giving everyone ample time to join.
Sure.
That's the first thing we want to do. We won't do it for very long, but we do this at our actual workshops that people attend in person. We want to give everybody a chance to get on board and join the Facebook Live. And we do want to encourage you to take a second to share the video on your page or share with someone who you would like to share with who might benefit from the topics tonight. And we can probably go down maybe an outline to start with what we are going to be talking about tonight.
Sure, Scott. We're going to talk about how things have really quickly changed. It was just a few weeks ago that things were going along great and our country was doing really well. And then all of a sudden, here we are. And so we're going to talk about that. We're going to talk with Ryan Detrick, our chief market strategist at LPL Financial, about the market economics of this, because there obviously are things that we're all concerned about as we have money invested in the markets. And there are things that we've got to just be sure that we understand where we are. So Ryan's going to join us for that. And unfortunately, guys, there are some scams that are cropping up these days around the coronavirus. As a matter of fact, I heard today that there is a scam of people going to small businesses and saying, hey, we can help you get your application in on this CARES package that is being offered to small businesses. So we're going to talk through that. And then we're also going to kind of venture into a couple of other areas, Janet.
So one of the things we're going to talk about is the emotions of investing. You know, we've said many times since this started that we were not as concerned about the financial impact of, the disease itself on businesses, on GDP, et cetera. We were more concerned about how people reacted to what was going on. And so we want to spend some time this evening talking about the emotions of investing. And I want to challenge you to find where you are on the curve of emotions so that you know a little bit more about how to handle your own investments with regard to your emotions.
So we also want to encourage you to ask questions, because we can talk about all the topics that we have on our presentation tonight, but if we don't answer your questions, we would consider that a failure. So we want to make sure that whatever's on your mind, you can put your comment or question into the chat box there while you're watching tonight, and we will address it, and we'll do our best. I know that a lot of people are spending a lot of time at home these days. It's our new normal.
Yeah.
I was thinking the other day that it's actually today thinking that it's only been almost 3 weeks, less than 3 weeks ago that we really started shutting everything down. It feels like it's been longer than that. And then when you think about the fact, John, that the stock market hit an all-time high on February 13th, about a month and a half ago. That feels like an eternity ago when you think about what we've been through since.
Yeah, and 47 days later, here we are in the midst of this crisis. The market has fallen a significant amount and then bounced back up, and we don't know whether that is what they call on Wall Street a dead cat bounce or whether it is actually going to be sustainable. Looks good right now. We did have a down day today on the market, but that's okay. Wasn't a severely down day, down about 1% or so. But we want to be sure that things are coming along. And Ryan's going to talk in just a little bit about how we can kind of know. That's one of the questions that we've got, Scott, is how do we know when things are going to be okay again as far as our investments are concerned, and when can we expect to return to where we were before? And that is a big open question for a lot of people.
In this same time period where we've had all the challenges with social distancing and the challenges to business and everything going on, we've also had oil prices just plummet. And so that's put us in another situation as far as the economy is concerned. So we want to look at that a little bit. And then also, most recently, and I'm sure that everybody is familiar with this one by now, at least to some degree, and that is that Washington has passed the CARES Act. So in response to the concern about businesses' ability and individuals' ability to continue and to do what they need to do to continue to earn money, whether it's through a business or individually, whatever the case is, Washington is responding with money, because if the economy stops, then it is, I'll use Reagan's word about the trickle-down economy. You know, if you don't go to work, then you don't get paid. And if you don't get paid, then you don't make your mortgage payment. If you don't make your mortgage payment, then the recipient of that doesn't get paid. And it really does trickle through all layers of the economy. And so they have put together the largest stimulus package in the history of our country, and we're going to spend some time talking about that this evening too.
So let me ask everybody, have you heard the new word that has come from this?
I think we have, but I'll be very transparent. I had not heard it before prepping for this.
Yeah. So the new word these days is COVIDiot. And that is an idiot who doesn't social distance, because that's a new word, is social, or new phrase, social distancing. Right. But those who don't social distance are being shamed into being called COVIDiots. Yeah. And so there's a lot of stuff going on, Scott, and we're going to spend a little bit of time on mindset tonight and what you need to be thinking about, because as Janet said, you know, what we do to ourselves could be more harmful than the virus itself. It could, and Brian Westbury, the chief economist at First Trust, talks a lot about this on some of the videos that he does. He talks about the fact that, yes, coronavirus is killing people, but so does joblessness and poverty and all of the things that could come from this. And so we're in a really interesting place in this country right now where there has to be this balance, this balancing act of, okay, how long do we shelter in place, or how long do we social distance and keep businesses closed and things of that nature, and how long do we allow the streets to be deserted before we try to get back to work? And there's going to be more and more pressure to get out and go do and things of that nature. We hope that the medical community can stave off this virus during that time.
Yeah, and we should point out too, in case you did miss Governor Hutchinson's press conference today, there was some potential good news in that. He did show a chart in which the cases of the coronavirus, now people infected in the state of Arkansas, is lower than what has been projected by the Department of Health. So it's possible, it's way too early to tell, I'm sure, but it's possible that we are beginning to flatten the curve because of the efforts that we have. And I think that's a big point in this is a self-inflicted wound. Everything we've done in response to the virus has been by choice over necessity. We didn't have to do this, but I think that's to the Americans' credit, to Arkansans' credit, that so many businesses shut their doors for the greater good. We are all sacrificing things for the greater good.
We did that here at GenWealth. Just to talk a little bit about GenWealth tonight, we shut our doors to the public on Monday of last week. So we've been closed a week and a day. That doesn't mean that we're actually out of business. We're continuing to do business. We're using technology. We're using all of the things that we've got at our fingertips to be able to continue to conduct business. We've been reaching out to many of you, our clients, talking to you about what are your concerns, what's going on. And of course, our team has really rallied around this. We've had a skeleton crew at our Bryant office taking phone calls and passing those phone calls out to our employees. And Janet, that was something we didn't really have the opportunity to do, but because we have the opportunity to do that now, we actually have advisors who are on standby right now, that if you've got questions about your particular situation, or you just want to come in and not necessarily come in.
In right now. We're still social distancing.
You can come in via our technology and actually do what you would know as a FaceTime visit, or maybe a I'm losing
Zoom.
the word. Zoom. There's lots of formats out there.
I feel like the majority of the country has learned how to use technology a little bit more in the last couple of weeks, and Zoom is one example. We have other methods that we can do, but I'll give you the parallel story on this is what I've been telling a lot of people as they've asked about, well, how do I do this? Because I really feel like I need to talk to a financial advisor, maybe now more than ever, but how do I do it with all the social distancing? The reality is we've had clients from out of state since we started GenWealth, and and all through that time, obviously technology has developed a great deal in that period of time, but all through those years, we've been able to have a relationship across many state lines. And so at this point, you may be 3 blocks away from wherever your advisor is. They're in their home and you're in yours. The technology is there for us to have a conversation, for us to share documents and all of that securely as though you were in the same meeting room. So I would urge you that, if you have some questions tonight, like John said, we have advisors standing by to be able to take your phone call tonight. We'll give that number several times, but I'll go ahead and give it out now. 501-653-7355. If you've got a question just, tonight, you can also let us know through Facebook Live. Just let us know that question and we'll try to get it answered on air. But you can reach out and talk to our advisors.
Guys, there could be questions out there like, can I still retire?
Yep.
Is that something that I can still do? Our advisors can help you to understand the dynamic of that question and help to give you some idea about what it will take for you to be able to retire. You may still be able to retire from where you were. This impact is a wound, but it's not fatal as far as the markets are concerned, so we can talk with you about that. And Scott, I think a lot of people really are asking, do I need to do something with my portfolio right now?
Yeah, that is the big question. Is it a great buying opportunity? Have we hit the bottom? Those are kind of common questions that we've heard, and we kind of took those questions and more to LPL senior market strategist Ryan Detrick. If you're not familiar with who Ryan is, has a big presence on social media. He is on many of the financial talk shows nationally, and he does join us occasionally and pretty much once a month on the Get Ready for the Future show, the radio and live stream program that we do on a weekly basis here at GenWealth. So we talked to Ryan earlier today, so this was just recorded really right at the close of trading on this final day of quarter number 1. It was a rough quarter, and that's where our conversation with Ryan starts. Well, Ryan, we certainly thank you for being with us once again, doing a little overtime with us, I might add. Second straight week you've been with us, but this very important time in our country and our economy, we certainly appreciate the time. I want to dive into a lot of things in our segment here today related to the coronavirus, of course, but I want to start with maybe the up-to-the-minute current situation. We had the first quarter end in trading today, and even though it did end up down a little more than a point, it was one of the least volatile days that we've actually had in recent weeks. So give us your take on the day trading today and really the overall first quarter.
Sure. Well, Scott, thank you for having me back. The whole team, thank you for having me back. And honestly, good riddance, right? I think that's the best answer we can give for the first quarter.
Yeah.
I haven't seen the exact numbers. I saw the headline on Market Watch, worst quarter for stocks since 2008. Now, like you said, today stocks are down a little over 1%. It almost felt like a nice break, right? I mean, we've been seeing 3 and 4% moves. I mean, just yesterday was up, 3%. Friday was down 3%. We get the gist of just this wild, volatile ride that we've had. I guess if there's any positive to it, we've had a pretty good bounce over the past week, right? The S&P up over 17% in 5 days, Dow up over 20% in 5 days. Some of the most historical best bounces we've ever seen. Of course, that came on the heels of some of the most vicious 4 week sell-offs we've ever seen in stock market history. So buckle up, second quarter could still be pretty volatile.
Ryan, let's talk a little bit about the CARES Act, the most massive stimulus ever passed in the United States Congress and signed by the president. Number one, is it enough? And secondly, how will this impact financial markets as we look ahead into the future?
Yeah, John, I mean, it is the largest. And you hear $2 trillion. We hear that number and we're kind of, it sounds like a lot. I mean, $2 trillion is an enormous amount of money. But to put it relative to what we did in 2008, that financial package, this one was over 9% of GDP. The package back in 2008 was 5% of GDP. What I'm getting at, this fiscal plan is nearly double what we did in the midst of the worst financial crisis in our country's history since the Great Depression. You talk about how quickly this happened. I mean, the market sold off, yes, but the fiscal plan that we had in 2008, it took months really to kind of come through. This one, because this problem started on Main Street with many, many normal people losing their jobs first, we think it's in a weird way beneficial because Congress got together and actually made it happen. Now, Big question is this enough? Literally the next day after they signed it, there were talks about another $600 billion stimulus plan. So we might have another one coming. But in the near term, the way we're viewing this is a bridge for small businesses and consumers that have been impacted by losing their jobs, to give a bridge for a couple of months, that if we can get some good news on the coronavirus, if the peaks can, the number of cases can peak, maybe a vaccine, although honestly that sounds like a next year thing. If we can get some good news and then companies can open up, this is that bridge that can guide people to hopefully expand the economy the second half of the year. Now I use the word hopefully. Hopefully is not a strategy, and that's where we really just don't know. But there could be a $600 billion, if not more, fiscal plan coming somewhere down the line, maybe sooner than later.
So let's follow up a little bit on that. We're talking about the CARES Act, and I love one of the things that Burt White has said, and his quote is that this is not a financial crisis, it is a business crisis. And that's really what the CARES Act is meant to address, at least in part. So help our listeners, help our viewers understand, how does this really help businesses? Because I know we know what's in there. We've talked about it a great deal, but I think a lot of our viewers don't really know what's in there for businesses.
No, that's right. And you think about 2008, who were the first people to lose their jobs? Rich Wall Street bankers, right? That's a lot different than now, and that's why we've called this a business crisis, not a financial crisis. But there's different things that are in there. Bottom line is the Fed now is potentially loaning money, to mom and pop, as they say. Businesses can go onto the website and they can apply for different types of loans. Now, there are some catches, and I've heard some people that are a little upset the government's making them do certain things, but the bottom line is the government's really working as best as they can to kind of bridge the just terrible impact that this has had on so many small businesses. And something also interesting I thought was unique. Yes, there's potentially $1,200 checks coming to all the individuals. There's $500 for children. 401k. If someone has a 401k and they just lost their job, they can actually tap into that without having the penalty. So those are some different things that we have never seen before that the government is letting us do. But we're encouraged by this, right? We needed some confidence, whether it be on the Fed monetary side, that's the Fed, or the fiscal side, that's the CARES Act. And we think this is some major steps in the right direction to just bring some normalcy, some confidence, and bringing back liquidity to markets. And that's it's a process, but we're encouraged by it.
You and your team at LPL Research have created the Road to Recovery playbook. Want to open that up now, if you would. First of all, what's the reason behind it? Why do you guys create it? What is it, and what's inside it?
Yeah, Scott, we released that 3 weeks ago, and the thought process behind it was, okay, stocks are down 30%. Do you just buy? No, you absolutely don't. Now, history would say when stocks are cheap like that, you hold for 3 or 5 years, you probably will make some gains, but we didn't want to just blindly say that. So in 2008, before I was there at LPL, Burt White did create some type of a Road to Recovery playbook. I forget exactly what he called it, but that's what we're calling this one. 5 different things that we're looking for. Things like, are we in a recession? Yes, last week's 3.3 million people losing their jobs confirmed that. Look what the market did last Thursday on that news. Went up 6%, right? It's almost like the market hates uncertainty. It can take bad news. It can take good news. But the bad news of, we're in a recession, market actually bounced on that. Well, the one thing, so sentiment is washed out, technicals are washed out, we have benefits from fiscal monetary policy. Those are all check marks in the good and the positive. The one thing out of the 5 things we're looking for in our playbook that's not there yet is a peak in the U.S. Cases of the COVID-19. If you look around the globe and kind of follow forecasting, we're probably about a week and a half away potentially from that. But once we can get that to happen and the cases start to decline, look at Seattle, right? Seattle is where the first big city to get hit with this. It's starting to see some good news. Spain and Italy both have decreasing new cases. So there is light at the end of a very, very scary and dark tunnel. And those are kind of the things we're looking at. But all in all, what we're saying just this week, guys, yesterday we went to overweight equities. We've been market weight equities for a year, since March of last year. We're checked off 4 out of the 5 on our playbook. We think that's good enough for us to say, you know what? We think stocks in the next 1 to 3 years here look like they should really do well relative to bonds. And that doesn't mean blindly go buy across the board, but in the money that we run, we are actively looking to start to add some equity exposure here.
Ryan, you mentioned bonds. I want to go back to that for just a second because there's great amount of transparency in the public eye in the stock market. All you have to do is turn on the TV, pull up the internet, and you can see what's going on in the stock market. Not so much in the bond market, and that's really very almost a mystery to a lot of people. What kind of effect is all of this having on the bond market, especially all this stimulus money, and where do you see that going?
Yeah, well, the bottom line is 2 weeks ago when the stock market had a massive, massive sell-off, gold got hit really hard and bonds, which are normally safe, right? Fixed income's normally safe, they got hit as well. Then the Fed came out and said, okay, we're going to be the backstop. We're going to buy all these different types of debt, whether it be municipals, whether it be munis, whether it be commercial municipal bonds, corporate bonds, all these different things. And some of those bonds really bounce back on the news. But the bottom line on bonds here, for the year, treasuries are up almost double digits. Okay, that's the longer end of the curve, but most bonds are higher on the year if you look at the Barclays Ag, which is your average bond here, with stocks down 20%. So that's a nice diversifier. We still think in any portfolio there's always a place for fixed income. But again, if you asked us what's going to do better the next 1 to 3 years, stocks are historically cheap relative to bonds. So we're going to be siding a little bit with stocks here. But I mean, hey, bonds, when we've had a volatility before, they've been a good diversifier, and we still think they will continue to provide that to a well-diversified portfolio.
Ryan, if you're thinking about the individual investor and they were already in the market, so to speak, they were already invested before all of this hit, and maybe they're early in retirement or they're coming up, with retirement right around the corner, what would you say to them? What advice would you give to that investor?
Yeah, well, obviously, if they've had equities and they've written it down, the way we would say is this: don't panic yet. And what I mean by that, the average bear market corrects 37% when you have a recession. We just went back 34%. We definitely think we're in a recession here. So could this get worse? Could we have a 50% correction like the previous 2 crises? I mean, it's possible. But again, when you look at the benefits of fiscal and monetary policy, the historic stuff that we just talked about, to us it makes sense. If you can look out into the future, there could be a lot better returns the second half of this year. So again, that's why they have guys like you guys, right? To help people from helping themselves. I mean, one simple thing that we're looking at doing right now is just rebalancing, right? People have less stocks than they did a month ago relative to bonds. Maybe just simply a little bit of rebalancing in a portfolio is what your average investor should do right here and now.
Final question for you, Ryan. You mentioned making the shift to overweight in equities as we look at this next 1 to 3 year time horizon. Are there any areas, particular investments that your team is looking at that might be a good opportunity?
Yeah, Scott, 2 areas we like and we've liked for a while and continue to like: technology and healthcare. Technology's been a true market leader. Look at the big names. They continue to make money, that have done very well. Those are still areas we like. And healthcare, when you look at all the different things going on with this virus, but just so many potential as people continue to age, those are 2 strong groups that we really like. And I'll leave it with this, and I hope I don't butcher it. Warren Buffett said, about every decade, when skies get dark, it rains gold. The best thing you can do is get your buckets ready. We think investors should be getting their buckets ready here and now.
Very good. Ryan, thank you very much for your time.
Thank you, guys. Appreciate it.
To Ryan, some great insight from him. Do want to mention that you can follow him on social media. He is very active on Twitter at Ryan Detrick. It's Detrick. If you want to follow Ryan, he tweets all the time. And he'll join us periodically, usually about once a month, on the Get Ready for the Future show. So we just spent a few minutes, guys, asking Ryan some questions, but we want to allow, as we mentioned at the top of the broadcast tonight, for people who are watching to ask questions. And we do have one I want to throw at you to start with from Sean Massey. He says, I've just come into some money through inheritance, and I keep going back and forth if I should just invest it all into the market right now or dollar cost average over the next 6 months or so. And he does say he has a 20-year retirement horizon.
That's a great question, Sean, and we really appreciate you chiming in with us tonight. The first thing that we would say is we want you to make a great decision, and making a great decision really does involve understanding where you are right now. And so one of the first things that we would recommend that you do is give one of our advisors a call tonight at 501-653-7355 and maybe set up a time so we can ask some specific questions. But let's take your question and answer it on a general broad basis, because primarily we want to do what's best for you. Until we know exactly what's best for you, we wouldn't want to give you specific investment direction, but let's talk in general about that for just a second. So Janet, let's deal with this, because he does have a large sum of money,
right,
and wants to know, do I put that to work all in the market right now, or do I dollar cost average over 6 months?
Well, And I'm going to broaden the question actually, and really throw it back to you, Sean, to think about what's important to you. I'll give you an example of something that we've dealt with. Another advisor and I met with somebody who also had some inheritance money recently, and what we discovered in this situation was it was very important to them to get their house paid off sooner than what they would have otherwise been able to do. And so what we're doing in their case is taking some of those earnings each year, and anytime that they're above water. So like if they had put it in recently and this was their 1 year marker, we would be down right now, and so we wouldn't take anything out. That's built into it. But anytime we're above water in their plan from what they originally invested, then we're just going to harvest those gains and use that to pay extra principal down on the mortgage. I know that wasn't part of your question, but the reason I tossed that out there is that was a personalized answer for that individual family. What we would really like to help you do is to understand, all right, what's unique in your situation? What's really important to you, Sean, that you want to be able to move yourself forward? There are some advantages sometimes to dollar cost averaging. The question at this point is, and nobody has the answer to this, are we at the bottom, or will it look worse in 6 months? LPL research, and we would agree, we feel like we'll be in a better place 6 months down the road than where we are right now, but we also don't feel like we're at the bottom right now. So I wouldn't worry so much about timing the market. We talk all the time about time in the market compared to timing the market. I think I would take some time and sit down with an advisor to determine what's going to be in your best interest in your overall financial picture.
Yeah, I would agree with that, Janet. And I think that there are a lot of people out there tonight that are going, I'm never going to be in this situation again. And Sean, I don't know what your situation is, but if you are having to say, I don't want to ever be in this situation again from a financial standpoint, then you definitely want to be sure that you get bulletproof. You want to get your 4 walls taken care of. That is food, clothing, transportation, shelter. Make sure all of that's solid, and a good solid emergency fund does that for you. So that'd be the first thing that we would talk about. Then we would talk about a little bit about how we wanted to apply that money. And there are pros and cons to going all in now. If the market goes straight up from here, then you made a good choice. If the market goes down, then goes back up, then dollar cost averaging would have been a better choice. But it really does depend on your situation, and that's why, Scott, planning is so important in almost any time, but more specifically in times like this. People really do need a financial advisor.
Yeah, absolutely. That's what I was going to say is it's a holistic approach to answer Sean's question that really needs to be more questions asked of him first before we could give him that answer. But it is a great question. No question about it. If you have some more that you'd like to send us, again, anybody watching tonight can do that by putting a comment in the chat section. So we did want to talk about, moving on to our next topic, we're going to talk about some scams that are going around. And unfortunately, this is really the reality of any crisis. It's always happening every day of the week in America, unfortunately, but when a crisis exists and people are more vulnerable, more emotional, more looking for answers than maybe they are on a day-to-day basis, these fraudsters and these scamsters seem to always be out on the prey.
They are, Scott. And let me just say that one of the things that we do here at GenWealth is to be sure that we're giving you factual information. We go to great lengths to be sure that we're not giving you a lot of hype or a lot of talk or anything of that nature, just a lot of facts. We believe in research. We believe in math and science when it comes to your finances. We believe that's where you need to look to. So these scammers are really just, they're a come on. They're really trying to appeal to your emotions. So let's take a look at some of the things that I think are very important for us to understand as far as scams are concerned, and hopefully we can help you to avoid some of those things. Number one thing is that you've got to watch for emails claiming to be from the Center for Disease Control and Prevention, the CDC. And now I would add to that the Small Business Administration, because the Small Business Administration is involved deeply in the CARES Act, and so you want to be sure that you're getting this directly from the source. If you have experts claiming to have inside information on the virus, there is no inside information on the virus unless you're hearing it from the officials themselves. That's the only place that you're really going to get inside information, Janet.
So the next point we would talk about is to be able to do your research before donating to any charities or crowdfunding sites. You know, we're going to talk later about emotions with regard to investing. I would say pay attention to your emotions with regard to scams, because when you hear a story about a family that, you know, maybe both parents passed away and they've got these young children and this money's going to help those kids go to college or whatever, it's okay to give if you know that the story is real, but you need to really pay attention, because there are a lot of people out there that'll just pull pictures from whatever source and tell, quote unquote, their story when it's not really true.
This next one, Scott, is the one that gets a lot of people in trouble. They get an email. It looks fairly legitimate. It has a link in it that says, if you'll just click here for more information, then you'll get the information that you're looking for. And when you click there, then you're down a rabbit hole and you can't get out. And that's something that everybody needs to always be aware of. But during this time of this crisis, you definitely want to be aware of that, because those are the things that can do even more damage to you than what we're going through right now. Also, I would say to be suspicious of urgent demands and emergency requests. You know, for a while there was this scam of, and one of our advisors actually was involved in a peripheral way on one of these. His grandmother got a call and said, Troy is in trouble. He is in jail in Florida and you need to send some money right now. Well, thankfully, the grandmother picked up the phone and called Troy and said,
called his mom.
Yeah, called his mom and
hey,
said, is Troy in trouble? Is he? No, he's at work. He's good. These things are out there all over the place. That's just going to be more prevalent in this day and time as people are looking for ways to get over on folks. And so those are, pardon me, Scott, those are just some things that we want to be mindful of, to make sure that you're getting information from trusted sources. Make sure you're not clicking on things that are going to create a problem for you down the road, and be sure that you're getting true information.
Okay, I do have another question. We can take a pause on the talk on scams really quickly here. And Late Owens Land asks, can I tap into my 401k at this time with no penalties or future penalties? And that's a change with the passage of the CARES Act that does allow for a temporary time, right? A temporary
Yes.
time that if you're under 59 and a half, there's no 10% penalty if you do that. But we've talked about this on the radio show earlier today. You want to be very careful about choosing to do that.
Yeah, you do. I think it's number one thing that you want to think about is that you're taking money out of your future living, out of your
Right.
future income when you take money out of your 401k plan. So while that is kind of a feel-good, knee-jerk, let's go get this money, it's easy, and we can go get it, not pay any penalty on taking it out, and we can defer taxes for the next couple of years on that. Sounds like a really easy thing to do. And if it's your last resort, it is an easy thing to do, and we would encourage you to do that if it is your last resort. But Janet, I think that sometimes people think about, let's do what is expedient
And comfortable.
and comfortable as
Yeah.
opposed to what is the right thing to do.
So let's talk about the rule of 72. The rule of 72 helps you figure out how long it's going to take your money to double. And so let's say that you're in your 40s and you've got maybe 20 years or so until retirement. Well, rule of 72 tells us that you can take whatever rate of return you're getting and divide that into 72, and whatever number you get is basically the number of years that it's going to take your money to double. So let's play out, you know, over a 25-year time period. Let's say the worst 25-year rolling time period there's ever been in the history of the market was 7.94%. Round it up, let's call it 8% for easy math. So if you divide 8 into 72, we get 9 years. So every 9 years, that money is going to double. So let's just do 18 years out from retirement. I keep changing my numbers, but it's easier math here for you. If you withdrew $50,000 and you have two doubling periods, because we've got 18 years, then that 50,000 would have turned to 100,000, and that 100,000 would have doubled again to 200,000. So when we look at this as financial advisors, you know, you probably don't need $50,000 withdrawn to help you bridge the gap just to survive. You
right.
might need 10, but realize that if you withdraw $50,000, it is a $200,000 impact on your retirement based on the timeline that I gave you in a worst case scenario market. And coming from this low point, it's probably not going to look like a worst case scenario over that period of time.
So let's talk about a couple of other things in regard to this, because I think it's important that you understand the consequences of the decision that you could be making if you take money out of your 401k plan. First things first. Number one, you're going to have to sell something in order to generate that cash. And when you sell something to generate that cash, you're probably selling it at a low point unless you had some conservative investments in your portfolio. That's probably not a good thing for you to have to do. Again, if you have to do it, that's one thing. But if you don't have to do it, look for ways around that. The second thing is, and let me be real straight and real honest with you about something. If you take money out of your 401k plan to fill a hole right now, you will really think, and you'll tell yourself, I'm going to pay that back at some point in time in the future. Tell me how you're going to do that. Even if things get back to normal, are you really going to be able to put that money back into your 401k plan? Because there are provisions to be able to do that in this law. But are you really going to be able to do that? Think about what you're sacrificing in the future. And again, our hearts go out to people that are incredibly, stressed by this. If you've lost your job, I get it. If you have been had your hours reduced, I get it. That may be the only thing that you have available to you is that 401k plan. But Scott, I think it's really one of those things that you've got to really be careful and be very judicious about what you do in that. And I would get the counsel of a financial advisor that can help you to understand the consequences of taking that out.
Let's do one more question before we move back to our topics. This is from Jonathan. As a small business, can you receive the CARES Act loan for payroll and also receive the SBA disaster recovery loan, or is it one or the other? So we're going kind of deep under the hood here of the CARES Act that was just passed by Congress and signed by the President on March 27th.
So the two areas that he was asking about were, tell me one more time.
Well, I got another one, so I'm going to have to move back up. Okay, as a small business, can you receive the CARES Act loan for payroll and also receive the SBA disaster recovery loan, or is it one or the other?
So we have honestly only looked into the payroll information ourselves, and we know a good bit about that. I will say in some of the things that I have read that there are, and this is not exactly where they're going with this question, but for example, there is a grant that is available, but if you do that and the payroll protection program, they wind up being merged in the calculation. So if you got the $10,000 grant, then it's going to be reduced from what you would receive from the payroll protection. So that's not an answer that we have for those particular two programs right now, but you can check into it. I will say I've talked about this on the radio this week as well. The document itself, when you look up the CARES Act, the document itself is easily understood. It really is. It's very searchable as well. When you pull it up, there's a list of all the different topics that are covered, and then you can go to that specific area. And as I said previously, if you have graduated high school, and then I believe that you can understand this document. It doesn't have to be terribly complicated. So that's not a specific one. John, do you have a different response on that?
Janet, I would say that there is, my understanding, my reading, and I'm not an attorney, I certainly didn't draft the legislation, but my understanding of this is that you could get the Paycheck Protection Program and you could get the disaster loan as well, but you have to use those for two different things. Mm-hmm. You can't double up on that. Right. You have to use it for two different things. Now, you could use it outside the qualified period, if you will, which I believe runs from March through May or June.
The end of June.
End of June. So the key here would be to talk to your banker or call the Small Business Administration and talk with them, because they're the folks that know all the ins and outs of this. But I believe that there are a larger pool of dollars available in the disaster loan area than in the Paycheck Protection Program, but you've got to have the qualifiers to be able to use those in each key area.
All right, we do have another question. I'll get to that in a minute, but I do want to finish the scam portion of the presentation. I think we had a couple more there. I think we left off there with, if it sounds too good to be true, it probably is. That doesn't need a whole lot of explanation, but there are a couple more on your list.
Yeah, be mindful of scammers using government aid packages for criminal gain, and I guarantee you there's going to be all kinds of things come out already. We've heard from one of our sources that people are lining up saying, hey, I can get you this this CARES Act money faster than any place else. They're wanting your personal private information is what they're wanting. They're wanting your social security number and date of birth so they can do all kinds of nefarious things with all of your other assets. And so you don't allow them to do that. Only deal with reputable parties when it comes to that. The other thing is obtain your news from a trusted source. We've tried to establish ourselves here at GenWealth as a trusted source for information. That's why we'll tell you if we know something, but we'll also tell you if we don't know it. But we will always point you to the right source for that information. Don't take something at face value just because you need that information and this out of the blue, here it comes, and all of a sudden it's right in front of you. It seems like a gift from God, but it can really get you into a lot of trouble.
I think I'll just go back to a common sense rule that we think about in normal times, but these times are anything but normal, and that is whatever your private information is, your social security number, your date of birth, we call it private information for a reason. And if somebody is contacting you rather than you reaching out to them, I would just encourage you to have an abundance of caution in giving out any information. You need to know absolutely for sure who it is you're speaking with. And again, the government already has your social security number. The bank that you work with already has your social security number. They don't need it. So just be aware about who you're giving information to.
Scott, let's go back to some questions.
Yeah, really good one here from John Antle. One of the proposals in the $2.2 trillion bill was to enable people to forego required distributions. He's talking about RMDs, required minimum distributions from 401ks and IRAs if they didn't need the money. Did that end up in the bill? Part one of the question. And if so, does that include inherited IRAs?
I am not sure about the inherited IRA. The bill does not speak to inherited IRAs. They are required minimum distributions, but when it comes to the IRS, if it's not in there, I would assume that the inherited IRA is not part of this plan. Now, what you can do this year and this year only is you can forego your required minimum distribution. You may be saying, John, what is a required minimum distribution? A required minimum distribution is simply just a distribution that is required by the IRS from your 401k plan, from your IRA, or any other type of tax-deferred retirement program that they require you to take out a certain amount of money, expose it to taxes so the government can get the money that they are looking for from that asset. It begins now at age 72. It used to begin at age 70 and a half. It now begins at age 72. Regardless of whether you began at 70 or 72, doesn't matter. You have the ability this year alone to skip your required minimum distribution. And Janet, that is really important.
It is.
Because, and it may be counterintuitive to some people because they may be saying, wait a minute, people need money. Why would they skip their required minimum distribution?
So people who have been working and are now not working need money. But if you're retired and you don't really need that check coming in, from your required minimum distribution, then you may very well be in a different boat. And you can say, I don't necessarily need that. So the reason it's advantageous, if you think about where the market has been and where it is now, if you have to sell from a low point to create that minimum distribution, you're selling more shares. But I want to circle back to the question about inherited IRAs specifically. Some people have inherited them in such a way where I'll just call it a clean inheritance, meaning you have your lifetime to stretch the receipt of that money. You have required minimum distributions over your lifetime. There are some people who received it through a little bit messier process. Maybe it had to go through probate, whatever the case may be, and they have a 5-year window during which they have to expose all of that inherited IRA to taxes. I will tell you that timeline still counts. As an example, we have a client who received some money that way, and they have to have all of their dollars exposed to taxes by December 31st of this year. In their case, it's actually a blessing because when that money's down, when the account value is down, then that means that their tax liability is going to be less. So that brings us into, now I know this was not part of the question, but it also brings us into the discussion about Roth Roth conversions, that if you've been in the process of converting from traditional IRA to Roth IRA, that now is really a good opportunity for you to reach out to your advisor and say, hey, I want to talk about that, because if you had a $10,000 amount that you wanted to convert and now it's $7,000, then it's a good time to do it because you're going to pay less in taxes. So again, the key is communication with your advisor on this.
And we should point out too that stretch IRA, you're very blessed to be able to do that,
Yes.
because it is in the past now. It
That's
no longer
right.
applies moving forward. That was not the CARES Act, that was the Secure Act that became law in January that requires you to take it out over a 10-year period, so you can't do that anymore.
I just
Right.
had that required minimum that Roth conversion question from one of my clients today. They had done a Roth conversion last year, thinking about doing one this year. Well, you're going to pay less in tax this year on that Roth conversion by converting the same number of shares, if you will, because it's actually worth less money, and so therefore you're only taxed on that reduced dollar amount.
There was a PS on John's question, by
Okay.
the way, just a little tidbit we'll have to do this later, I guess, but his PS was, if you Google what does $1 trillion look like, you'll get a really cool PowerPoint as to how much money it is visually speaking.
Bert White, the Chief Investment Officer at LPL Financial, shared with us some information on what $2 trillion is, and this is really interesting. He said if you go back to 60,000 BC, now that's a long time ago. I wasn't even around in 60,000 BC, as Janet might
Nobody
try to-
was, so they don't even really know if it was
that's
60,000
true.
BC, right?
But at any rate, he said if you go back to 60,000 BC and count forward the number of seconds that have passed since 60,000 BC to today,
Yeah.
that's roughly 2 trillion seconds. So that's how much money we're talking about in this bill.
Yeah. All right, one more question before we move on. This is from Corley Overall. Will a recipient of the stimulus money be taxed next year as added yearly income that could potentially put someone into a higher tax bracket?
The answer to this, hallelujah, is no. There is no tax on any of the stimulus money. There is no tax on the $1,200 checks that are going out to people that are under $100,000 a year in income. There's no tax on the $500 checks that are going to kids. There's no tax on the Paycheck Protection Program. Now, you'll still pay taxes on your paycheck if you still get a paycheck, but there are no taxes on the money that's coming in to allow that business to continue to give you that paycheck.
Well, and even on it being forgiven, because I mean everybody's heard about, if you have a debt that is forgiven, it gets counted against you tax wise. It does not, and it specifically says that in the bill. So
Yes.
again, this is Washington saying everybody needs to go to work, and we want to keep employers in a position where they can keep employees on their payroll. So that's why there's not a kick on this on the back end.
Let me say this. This really tells you what a big deal this is, how urgent this was. Have you ever known, Social Security is tax.
Yes.
Everything
Right.
the government does, they're looking for tax money back on it.
Yeah.
They didn't even bother to do that this time. They said, look, just forget all that. Here, have some money. And by the way, we're going to probably give you some more before this is all over.
So one of the things in the interviews that I've had a chance to do on radio and TV over the last few weeks that's been asked is, what should clients do? What should investors do as this market roller coaster occurs right before them? And one of the things I brought up is that you have to take the emotion out of this. And that's very, very difficult to do for someone. We are emotionally attached to our money. I said on the interviews that I look at every one of my clients' accounts on a daily basis except for one, and that's my own, because I am emotionally attached to it. So we're going to talk a little bit about the emotional impact that people are no doubt going through a lot of different emotions right now, but there is a really perceived path that as the market goes down and then eventually goes back up, that people go through.
Yeah, this is one of the first things that I ever learned as a financial advisor, and we've got it on the screen back here in case you'll put it up full screen so everybody can see it. But you go through this period of time when the market is going up, you're optimistic, you're impatient, you're wanting things to happen, you're really excited about it, and man, you're just over the top when the market is at a peak. What most people don't realize is that is the greatest risk of loss at that particular point in time. You're at the high. You are where we were back in February. As a matter of fact, the market had hit all-time highs, and we were doing really well, and everybody was really beginning to be a little bit overconfident.
And here's what happens at overconfidence. You see your account balance and you think that's going to stay there, right? It's never going to go back down.
And it's always going to go up, and
Yes.
it's never going to go back down. And then when it begins to go over the hill there, sort of down the hill, you can see that we go into that area of denial and go, oh, this isn't happening. This will all be okay.
Right.
And then you start beginning to regret a little bit. You begin to feel like, okay, should I have done this? Should I put all that money in that 401k plan? And so the more it goes down, fear, panic, and we've seen that panic. We saw a lot of people panicking a couple of weeks ago when the market started down. Thankfully, our clients did not panic. I want to congratulate all of our clients that are watching tonight. You guys have performed admirably through this, because when we reached out to you and said, hey, how are you doing? You guys said, we're doing okay. We're concerned, but we're doing okay because I understand my plan. And that's the beauty of having a plan. You understand what's going on. You understand the money that you are down in the market with is really money that you won't use, Janet, for 10, 15, 20 years down the road.
You're absolutely right. And that's something we're going to circle back to a little bit later. We'll look at an example with some buckets of money for different time periods. But I want to talk a little bit more about panic, because John, you and I, just because we were around as advisors in 2008, we saw panic set in for people and then last for really an extended period of time, because one of the signs of panic is going to cash with what really should be investment money, and it's sitting in cash instead. And there were people who remained in a cash position easily for a decade. And so we want to be sure that you're able to move out of that panic decision or time period and through the next phase, which is indecision, because as my husband likes to say, indecision will become your decision.
Janet, these are the 5 emotions that you've got to avoid in investing in the market. Panic will get you in trouble. Indecision will also get you in trouble. You've got to be sure that you have decisions made at a time when you're not under stress. And that's what's so beautiful about the planning process, is you can anticipate things like this. Now, did we know that there was going to be a COVID-19 pandemic in America? No, we didn't know that. But what we did know was there was going to be a time where the markets repeated the downturns that we've seen in the past. How did we know that? Well, history doesn't repeat itself, but it rhymes, as some folks are fond of saying. And so we see rhymes of 2008 in what's going on today. We see rhymes of 2001 in what's going on today. A lot of similarities in a couple of areas, a lot of differences in a couple of areas.
Absolutely.
But that indecision, because have you ever seen the squirrel in the middle of the road and the car's coming and he doesn't quite know what to do? Bloom. And then that's it. Squirrel's done. That's what indecision gets you.
Right. And so I think, it's important to have a coach, somebody who doesn't have the emotions. Like Scott, you said, you look at everybody's portfolio except for yours. And the reason is you can't separate those emotions. So it's important to work with a coach who can walk you through, all right, in your situation, here's what I would do if I were in your shoes, and just remove those emotions from the whole situation.
Absolutely. So let's talk about another emotion, and that's impatience. A lot of times people are impatient when the market's going up. Man, I need to get this in. I need to go. I need to get money in. We saw some impatience, quite frankly, when this all started, and there was this combination of COVID-19 and the oil situation hit. A lot of people were calling us to invest money in oil stocks, and they invested and they invested and they invested all the way down, and then all of a sudden it hit rock bottom, and the phone kind of stopped ringing because people were like, "Whoa, wait a minute, what's going on here?" So impatience can be a bit of a problem for you, and that is an emotion that is a danger in terms of investing. Another one is overconfidence. You want to be sure that you're not too cocky about this, quite frankly. You don't want to run in guns blazing going, yeah, now's my time, this is it. We talked about this a little bit with Ryan Detrick just today about the market, and yes, we've had a run up in the market of about 20%. Does that mean we're home free and we're going back up to the 30,000 level on the Dow that we saw earlier? That does not mean that. As a matter of fact, we could retest the lows. And so don't be overconfident at any particular point in time in the market, especially when the market's really high. You don't want to be overconfident and think that this is just going to continue from now on.
So these first two that we've talked about, the impatience and the overconfidence, are really areas that you're probably not experiencing those right now so much. It's really more of the next few phases, and that is fear and then panic and then indecision. And we've talked about those a little bit already, but I want you to think about where are you with regard to those three emotions. I would say that most people are probably in one of those two phases. They're either in fear, or one of those three phases, I should say. They're either in fear, or they're in panic, or they're in indecision. So you've got to understand where you are on this and be able to identify that and to work with an advisor who can move you through this path of emotions.
Speaking of working with an advisor, if you're experiencing any of these emotions, or if you just are wondering what's going on, what do I need to do, our advisor team is standing by right now. You can call our office at 501-653-7355, and one of the ladies will answer the phone. They will get you to an advisor in your locale that will be able to talk with you about what's happening, and if you so desire, they'll be able to set a time that they can get with you more formally and talk about your situation. And if you need to be doing some things right now, don't put this off. It is really something that you really need to be thinking about where you go from here. Don't go and hide and put yourself in a position where you're not going to participate in the recovery when it comes. Talk to an advisor and give us a call here at GenWealth at 501-653-7355.
I'm going to call an audible for Casey if he could put that roller coaster graphic of emotions back up. I wanted to point out when we were talking about these 5 emotions. You're going to actually do that.
I did that.
I forgot you're driving.
Done.
So let's take a look at where 2 of the most damaging emotions are. Overconfidence. Look where it happens. At the top of the market. That's the greatest risk of loss, is when we're feeling pretty good and deciding to pour more money in, right? And
Right.
then that's when it drops. And then the bottom of that, the worst one, is despair at the bottom of the market, and that's the greatest opportunity for gain. And
Yes.
that's when we're feeling less likely to be putting in money.
Yeah, a lot of people will go, well, I don't want to go talk to those people at GenWealth right now because this market, I don't know what it's going to do. All they're going to want to do is put my money in the market. That's really not the case. What we want to do is help you plan. We want to help you make smart decisions. And that is the key to overcoming the coronavirus from a financial standpoint, at least. We don't have the cure for the virus. I wish
Right.
we did. We'd all be rich if we had that cure. But what we do have is a way to really understand the value of planning and how you can get around this from a financial standpoint as best you can.
So we have another question, and I think it leads right into where we were going next, Jan.
Okay.
So the question is from Johnny Sue Burnett Wynn, and she says, what about those looking to retire in less than 5 years? So we've talked about riding this wave, and if you're a long-term investor, and that really all your long-term investments should be in the equity market. So that's the part that's gone down. You shouldn't be looking to sell that anytime soon. That's 15 to 20 year money, right? But what if you are retiring in the next 4 or 5 years, maybe this year, Janet, and you are looking at your nest egg going down at maybe various levels of down, depending on how you're invested. If you're more diversified, you didn't take the full brunt of what's happened in the stock market. But how do you look at your retirement possibilities in lieu of where we are in the market?
So I want to take a minute, and we're actually going to go to the whiteboard on this, and we're going to talk about, in this situation, what do you need to know that is maybe a little bit different than conventional wisdom. And so as an example, if you were to go, let's say you have $1 million, and you were to go and you're ready to invest for retirement, and you ask, all right, how much can I withdraw from that? In many cases, what's going to happen, you've got your portfolio here, $1 million, and most advisors are going to say you can withdraw 4% a year. Well, let's do the math on this. So if you withdraw 4% off of $1 million, that's going to be $40,000 each year. All right, you can use that to supplement your retirement and with Social Security, pension, whatever else you might have. So your $1 million is producing $40,000 at that 4% withdrawal rate. That's all well and good until it isn't, and times will change, just like they have right now. So if you think about the example I was using, this pre-COVID-19 was 2008. So what happened to the market in 2008? Well, it was down basically 40%. So let's do the math on this. If your $1 million, don't even worry about the math on your withdrawal rate, but if your $1 million is down 40%, it now has a value of $600,000. So let's go back to how much are you withdrawing? It's $40,000 a year because that's 4% of the original million. Well, if we're going to stick with the 4% rule, now it's 4% not of a million, which would give us 40,000, but it's 4% of $600,000. So that gives us $24,000 in income. How many people out there are wanting to take a pay cut to go from $40,000 a year to $24,000 a year? Scott, did we have anybody on Facebook who said, ooh, 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 I'll do that?
No hands raised, no emojis, nothing.
Nobody's stepping up to do that. Nobody wants to take a pay decrease. So we can't do just 4% off of the lower balance. So what if we say, all right, I can't take that pay decrease. I want to stick with $40,000. Well, $40,000 off of $600,000 is not a 4% withdrawal rate. It is a 6.7% withdrawal rate. And I can tell you now, you don't have to be a mathematician to know you're going to run out of money. Okay, so how do we negate this? The reality is this is going to happen again. It had happened, in the early 2000s. There were lots of reasons behind that in 2000, 2001, 2002. It happened in 2008. It's happening again now. How do you negate this risk? Well, if you guys were listening to Ryan earlier, he talked about having your buckets ready. I love that he used that terminology because we believe that buckets of money are critical to how you do your retirement. So you've got to look at how much money you have to have guaranteed to you, and that's going to be something that we separate over here. So you might have Social Security, you might have pension, and we'll look at that and whether or not there's a gap. If there's a gap, we're going to go to a product that has guaranteed income for you so that we know whatever your need is that you have to have every month is coming in. But then let's talk about the buckets. So if we have 3 different buckets here, and in reality you would really have more, but over time, this is your first 10 years of retirement. This is years 11 to 15. And this is years 16 and beyond, okay? So the challenge is this money up here, this $1 million, it was all invested in the market, so to speak, all right? It wasn't segmented for time. They were drawing off the entire bucket. The beauty of this is with these different buckets, this first bucket is conservatively invested. And so when we have times like what we're having now or what we had in 2008, this bucket is going to see 0 to minimal impact. So this one is more moderate, and this one out here is the only one that's really growth oriented. But notice we don't need this until 16 years into retirement. So we have a decade and a half before we get into this bucket of money. So here's what the conversations sound like among GenWealth clients. When the market started plummeting, and some people in other places were looking at this and going, oh my goodness, now our account value is down tremendously, our clients were able to look at each other, and one of them says, honey, have you looked at where our balances are? Kind of concerned. And the other one says, you know what? Remember that account that's down? That's our long-term bucket. We don't need that for another decade and a half. What do you want to do for dinner tonight? And I don't want to oversimplify that, but truly that is a reflection of the attitude that our clients have had because of the segmentation of this. This is how you negate this risk in retirement. And I'll tell you guys, whether it has a coronavirus label or a financial crisis of 2008, every group of retirees has at least one, and frankly, many times more than one, crisis du jour, as we call it, that is going to impact part of their retirement. The issue is it doesn't have to impact your retirement income, and you've got to be prepared ahead of time to address that.
So let's say that plan's not in place, but I am 4 or 5 years out from wanting to retire, and my $1 million through all of this was in equities, and I'm looking at $700,000 instead of $1 million. I'm sure a lot of people are going, well, I can't retire. Well, maybe you can, maybe you can't. I would encourage them to change the thought process to
Right.
the asset level into, well, what about income?
Yeah, the income part is a critical question, Scott. It is all about income. You really don't walk around spending your lump sum of money. You walk around spending your paycheck, if
That's
you
right.
will. And what you've got to do in retirement is you've got to create a retirement paycheck. Just like you had a regular paycheck when you were working, you need a retirement paycheck. And so when you design your plan that way and you have enough assets to be able to do that, then it is really almost irrelevant what your lump sum is, as long as the income that you have coming in on a regular monthly basis is enough to meet your basic needs, and then some of the stuff that you really would like to do, some of the desires that you have in retirement. Only through math and science and research can you figure out whether that makes sense or not. It's not a feeling. It's not a gut level, oh, wow, I took a hit there. I can't do it. I can't tell you the number of times over the years that Janet and I have sat down, and our team has sat down with people, and they've went, you mean I can retire? I didn't think I had enough money to retire. Wow, that's amazing. Doesn't work out every time, but a lot of times people are really surprised by what their money can do for them in retirement.
And the goal here is a consistent retirement income with raises over time.
Right, absolutely.
Yeah, not necessarily the asset level.
Any other questions that we've got from
I'm
the
going to
team?
check one more time. I was trying to stall. That's what I was
I got you. Okay.
I do want to give you guys one more opportunity to send a question. And we told you we would be out in about an hour, and it is now 8:06, so we want to make sure that we honor that. But we are going to let a couple of more minutes pass just to see if any more questions pop up before we go.
Scott, let me encourage folks that we will have advisors on standby for a few more minutes after the broadcast. Call our office, 501-653-7355. That's 501-653-7355. We've got ladies standing by to answer the phone. We've got advisors standing by to answer key questions for you, to talk through your particular situation. Of course, on our broadcast, we can't give you specific information because we don't know you. We can't interact with you and ask questions and understand your situation. But our advisors on the phone can, and they can talk through this with you, help you to understand, okay, here's where I'm at right now, and here are some of the moves that I might need to make. Give our office a call at 501-653-7355. Speak with an advisor and allow that advisor to talk with you about what we do here at GenWealth Financial Advisors. If there are other comments or questions come in on our Facebook Live feed, we will go ahead and answer those at the end of the broadcast. I have to say, Janet, it has been great being with all the folks that have been online with us tonight. This is our first time to do this. It's been a great opportunity to do this, and I know that we think that we're really doing our best to help people right now.
Yeah, I love that social media has given us an opportunity to overcome the challenges of social distancing. So as you continue to have to social distance, if you have questions for us, we're available, and we appreciate you joining us this evening.
Okay, we're going to wrap things up for us tonight. Again, our advisors are available at 501-653-7355. Scott Inman has some final thoughts for us.
Well, we talked about a lot tonight. But as we come to the end of our time together, we believe that surviving this current crisis and even thriving on the other side of it hinge on just one thing: our resolve. Bert White, who is the Managing Director and Chief Investment Officer at LPL Financial, recently wrote about this in a letter to clients. He wrote, "Resolve requires more than just the courage to stare down the unknown. It is the commitment to overcome it." We are already seeing this play out. We're seeing it with our healthcare workers and first responders who are resolved to treat those infected, no matter the risk to their own health. I heard one doctor say of her profession, when you join the Army, you have to be prepared to march. They are marching. Fatigued, emotionally drained, they are still marching. They are committed to doing whatever it takes to overcome the crisis. We're seeing it among scientists, public health officials, and other leaders who are working tirelessly to bring us the most up-to-date information every day and guide us in actions that we can take to reduce the spread of the virus. We're seeing it among the dedicated workers who are restocking shelves, manning checkout counters, managing the supply chain, and transporting the goods every day so that we can still feed our families and maintain at least some normalcy in our lives. And we're seeing it among small businesses and big corporations who are willingly taking a major financial blow for the greater good, and some of whom who are even using their minds, facilities, and products to help treat those infected and find a cure in the future. All of this brings short-term pain. How short-term remains to be seen. We believe the stock market is pricing in the full extent of a recession, but we also believe in a full recovery. According to LPL Research, during the unusually deadly influenza outbreak of 1918, stocks dropped 33% before recovering. About 50 years later, in 1969, a dangerous flu pandemic drove markets down 36%. Today, ironically, about 50 years or so later, markets have declined a similar amount. While we don't know for sure when our economy or even our way of life will return to normal, we must resolve to believe that it will. I believe resolve also requires faith. Faith that you're doing the right thing. Without it, it's difficult to commit to overcome anything. It's too easy to change direction or listen to the voices that prey on your emotions. That's true in our spiritual lives. It's also true in our financial lives. If you have a plan, you have to have the faith that it is still working when nothing else seems to be. That's the only way you'll stick to it. Things may get tougher before they get better, but it's our resolve that will keep us rooted and keep our eyes set on better days in the future. Thanks for joining us tonight. If you'd like to talk to an advisor, you can do that right now by calling.